All right, time to talk business news. Catherine Dorazio is with us this morning.
Good morning, Sophie, after a beautiful weekend.
Yes, it was a beautiful weekend, and lots of people probably heading across the border to do some shopping. They might have thought about waiting until next week,
until Friday on June 1st. The increases to our duty-free spending limits go up.
I know it's something people have been anticipating for quite a while.
Since March, when it was announced by the federal budget, and really the increases are quite significant in what they're calling long overdue. So the over 24-hour stays now will go up from $50 to $200. Over 48 hours will go up from $400 to $800. Right. So under 24-hour stays stay the same. There's no changes to the alcohol or the tobacco limits.
Oh, that's kind of too bad. But you know, you can't get everything all the time, right? So what I've heard from some people is that they'll go down there and they'll be totally honest when they come back and say, oh, I bought, I don't know, $700 worth of stuff in a 24-hour period or whatever. And they aren't asked to pay anything.
Well, increasing these limits will help people be honest and take off some time requirements of looking into some of the smaller overages, I guess we'll call it. Right. But there's still great incentive for people to go down. There's about a 14% gap between the prices we pay in Canada and that in the U.S. So there's quite an encouragement, especially with our Canadian dollar at par as well.
Right, right.
Yeah.
So that's something that we always talk about as well when the Canadian dollar is on par with the U.S. or even above par with the U.S. The discrepancy in pricing is still really apparent to many people, and people still go down to the States to shop. It's like the caramel secret. What is behind that?
Well, we have higher wholesale costs in Canada, and consumers or retailers, in Canada are asking the Canadian government to start looking into that, because there's about a 14% gap right now. It's come down from about 20%. So that's everything from your running shoes to your lawnmower, Steve, in the background here. You can be getting that at quite a significant discount. Right. So there's incentive to go down whether our dollar's at par. Right. Or not. Yeah. And then with these limits, we'll be able to bring back more. So the retailers are a little bit worried. We have a soft economy right now, and we need consumers to spend locally in order to continue to keep our economic recovery in shape.
Yeah, that's a really good point that, you know, while we may be saving some bucks down south, that's money that local businesses are not getting, and that's local taxes that are not being collected.
Exactly. It's about a $20 billion cost on our Canadian economy. And that's going to go up because that's what the current numbers are. Right. So with more incentive for Canadians to go across the border, we have to be very careful to how that hurts everything locally as well.
All right, Catherine, thanks so much.
Thank you so much, Sophie.
We'll see you again tomorrow. If you'd like to get more from Catherine, here's where you can reach her. See Dorazio at cclgroup.com, and there's her number, 604-643-5829, of course, with Connor, Clark & Lunn Private Capital. All right,
Catherine Dorazio is with us from Connor, Clark & Lunn. How are you?
I'm very well this morning.
Good. You've got lots of stuff to talk about, but let's begin with the numbers that are coming out later this week will be key to everything you're talking about. So
you know what? It's all interrelated, and the markets definitely know that as well. So the Bank of Canada's expected GDP around about 2.5%. Okay. But on Friday, we'll have those actual numbers, and forecasts are coming in a little bit lower, a medium range of about 1.9%.
Wow.
So even though we've had some stable economic numbers coming through and some modest growth, that will probably change the direction of seeing any increases of interest rates, which I think the Bank of Canada was hoping to finally get to.
Why are those numbers so important? Why are they looking at them so closely?
Well, those numbers look at kind of how our economy is, and then whether we could tolerate some changes, such as an increased rate increase.
Yeah, and you're talking about the interest rate, and a lot of people, obviously, with mortgages and floating lines of credit will be looking at that. So the Bank of Canada has hinted that there will be a rate increase eventually. So is this a good thing that we're seeing where these numbers are? That will
depends on what side of the street you sit.
Yeah, that's true. Yeah.
Yeah. So right now we would expect now rates to probably be put on hold. Some flare up in the economic picture has also kind of made everything policymakers say, you know what, let's keep things where we are. We need a healthy, stable economy, and you know, with the interest rates low, we'll expect probably then those mortgage rates and the housing sector kind of to continue where it is as well.
Now, are we still seeing some effects of the European debt crisis over here in Canada as well?
Yeah, you know what, we're a trading economy, so we definitely have some shocks of what happens in Europe affecting us locally here. maybe through some more indirect channels. Our banks don't have a modest amount of exposure. But Canada's doing pretty much everything it can to keep our economy very stable, make sure our banks are well regulated, and then chip away at our deficits. So the shocks are a little bit more on the investor sentiment and how they react in the markets.
Now, what about, we were talking about mortgage rates, and I've seen a couple of companies advertising lower rates than normal. And are we going to get back to where we saw just before the big crash of people saying, I can give you the lowest rate possible, and are we going to see those wars happening once again?
Which crash are we talking about? The mortgage wars of February, not too long
that's
ago.
Right. True, yeah.
Yeah, so the banks could afford to lower rates. So their funding costs right now would allow them to look at another kind of mortgage war type scenario. However, they had a little bit of a talking to when we saw that happen in February by the Bank of Canada.
Right.
So I would expect them here to probably keep the rates where they are, might hint towards it getting a little bit lower on some of the terms, but other than that, I don't think we'll see the mortgage wars that we saw back in February.
All right, if you want some more information, we invite you to check out Catherine at her email, which is cdorazio@cclgroup.com, and her phone number's there as well. Thanks very much. We'll see you tomorrow.
Thank you.
All right.
All right, time to check business news with Catherine Dorazio from Connor Clark and Lund. Thanks for coming in this morning.
Yes, thanks for having me.
We brought our blackberries.
We did. They're the topic of conversation.
Well, they still work for us, but not really working out that well for RIM, Research in Motion, right now.
No, Research in Motion is definitely on a string of bad news right now, and they reported their first operating loss in 9 years yesterday. Now, that announcement, they halted the stock before an announcement was made, and then on resuming trading, it dropped 11%. So it's under $10 now, which is the first time we see that kind of price in about 8 years.
So what are they doing to try to right the ship, to turn things around?
Well, there's kind of two things. They've really put all their resources towards the launch of their new BlackBerry, the BlackBerry 10, which is expected to be out in early fall. So most of the resources and kind of looking for a home run there. They've also hired some strategic partners, JP Morgan Securities as well as RBC Dominion, to look at really strategically what they can do, licensing arrangements, possibly even an outright sale.
And who would be the candidate for that sale, for the takeover?
You know,
potentially?
I think the bankers have their work cut out. Obviously, this company has got some troubles ahead, as well as what we've seen today.
Yeah.
You know, there is speculation. Even the New York Times has put Facebook, actually our other technology darling of the last month, on the table, because they've been saying for quite some time they'd like to get in the smartphone market.
Right, yeah, Steve was mentioning that this morning. I was just reminiscing this morning on the whole controversy over Jim Balsillie when he was trying to get an NHL team up in Canada. And, you know, where would that team be right now if he'd actually managed to get it in Hamilton? Anyway, that's just speculation. But so Facebook, as you mentioned, the other darling.
Yeah, it had a rough day yesterday too. So option trading started yesterday, and that pushed the stock down. Now it's about actually down 24% since the original IPO price. So that shows that there was a lot more bearish views on the stock in the market. And looking at kind of what they can do, because they haven't confirmed a revenue source yet.
Right.
But if we do want to speculate, their IPO revenue generated 3 times the market cap of RIMS. So you never know.
Is it that unusual? I mean, that's a very big drop, but is it that unusual for at least somewhat of a drop? You know, right after a company does go public, to see
well,
that?
there's the IPO. We became familiar with it being the pop, actually, so going in more of a positive direction. There were definitely some challenges right from the technology that was part of the IPO on the NASDAQ for Facebook. But yeah, you know what, there is a little bit of movement that's always seen right on the outside.
Just not quite this much.
And I think there's
And
a
not quite
longer
this much down.
there's a longer term story for Facebook here.
Yeah.
We can't really judge its upcoming potential just on this last few weeks.
Right. Okay. Thanks so much, Catherine.
Yeah, thanks, Sophie.
Thanks for being with us. Catherine from Connor Clark and Lund, of course.